if you look at some market periods where there was a lot of panic, when we look at a multi-asset portfolio which is well diversified with uncorrelated assets, how would have that performed?
So the way we try and look at it in terms of an absolute return compared to the market, for example, if the market is falling 15-20%, can I still be flat? Can I still be sub 5% in terms of drawdowns? This is what we saw in March of 2026.
What are the key mistakes people make when they're trying to create a multi-asset portfolio?
The key to making money in the markets is having good entry points and seeing markets with a lens of risk. Say Buffett or good investors that outperformed is by knowing when to be risk on and when to be risk off.
Welcome back to Leverage by Qode, where quant thinkers take the mic and we decode markets through a sharper lens. In our last episode, we explored momentum investing. This episode is about correlation, or more importantly, the absence of it. In late February 2026, US and Israeli airstrikes on Iran triggered a sharp global reaction. Brent crude surged from around $72 to nearly $120, and Indian markets saw one of their sharpest drawdowns in recent history, with significant FII outflows and currency pressure. For fully equity portfolios, it was a difficult period. For well-constructed multi-asset portfolios, the experience was meaningfully different. That difference is what we break down today. So thank you, Rishabh and Gaurav, and really excited for this conversation. Let's get started.
Thanks, Prateek.
Thanks Pradeep.
Everyone talks about diversification and correlation. These both concepts are different. Can you please explain the difference and why is it important to have both? When you're trying to diversify, you need to have uncorrelated assets. If you can just explain that relationship.
So with diversification, when you're thinking of diversification, the most common thought that comes is, you need to have maybe a 30, 40, 50 stock portfolio, just like mutual funds. So that's a diversified equity portfolio. A diversified equity portfolio does not reduce the volatility on your entire portfolio. It saves you from picking a bad stock. So if you picked a bad stock and you did badly and the stock is down 50%, it will not punish your entire portfolio. But if you see a bear market where everything is down, say 2008 or 2020 or the 2025, just when the war was going on last month, everything is down. So that diversified portfolio does not protect your entire book as a whole. So that is that is equity diversification. And then there is uncorrelated assets. When you're looking at uncorrelated assets, this sort of applies to larger ticket size investors, or larger ticket size investors start thinking about this problem more deeply, wherein you think, okay fine, some allocation should be to bonds, some allocation should be to real estate, some allocation should be to equities. Within equities also different kinds of equities, maybe some asset to commodities also. And they think of that problem more deeply because now protection of capital becomes a more important, or something that is given priority over just compounding. So yeah, that those are the two things when you're looking at diversification and uncorrelated assets.
Correct. I think broadly, Rishabh mentioned it right, but broadly people think that I'm diversified if I'm holding more assets. That asset could be in number of stocks, but also people think about it in terms of number of mutual funds. For example, you'll hold 7-8 different mutual funds, each of them hold 70-80 stocks. So on paper you might think that you're diversified, but let's say all the mutual funds that you hold are all large cap mutual funds. Maybe there's 80-90% overlap within those mutual funds itself. So the idea is not, diversification is not more assets which are not correlated to each other. An example that I can give you is, let's say if you just look at Nifty over the last 20-25 years has given close to 11-12% return. Same period if you look at gold has given close to 10-11% return over the same time. But now if I was to hold both in my portfolio, I would see that the returns have come at different times, and then the drawdowns between those assets have come at different times. I'm saying relatively different times. So what ends up happening is, when one thing might be performing, the other thing might not be performing at the same time, and at the end I still get close to 11-12% return, but I don't end up seeing that much volatility on my portfolio. So in true sense, diversification comes from assets which are not correlated to each other, but not just in terms of number of assets that you're holding.
Right. So there's a good diversification and there's a bad diversification. You need to understand what ends up making your portfolio better.
Correct.
So if you look at some market crisis or some periods where there was a lot of panic, when we look at a multi-asset portfolio which is well diversified with uncorrelated assets, how would have that perform? If you can give us some examples like COVID, Russia, Ukraine, how would the portfolio do when equities took a real beating?
So yeah, it's a valid question. What we've seen historically over the last 20, 30 years of data is that at least 8 out of 10 scenarios, multi-asset funds end up doing really well in bear markets when equities are doing really badly. So 2008, 2020, when we are looking at multi-asset and we try to dissect it, the large diversification is between equities and commodities. So there's an equity book and then there's a commodity book. The commodity book can have gold, silver, and copper or other metals. And the equity book could also be diversified, which could have like say a large cap and a small cap, or diversification based on factor, which is value and momentum or low wall momentum, etc. What we've seen with something that we run at Qode, our flagship strategy, Qode All Weather, in a phase like 2008 or even this 2024 2025 phase, during the bear market, as a multi-asset fund, we ended up doing extremely well. We've not seen large drawdowns. So when Nifty is down about 15-20%, our drawdowns have been sub 7-8% or 9%, and that outperforming during a bear market gives you a lot of confidence as an investor, because when there'll be a time in the bear market where things will be extremely cheap and shouting cheap, you will have the confidence to take that leap and actually move funds to more risky assets. Otherwise, if you're down 25-30%, you're already frazzled, you're already shaken by the market, and you might not have that emotional intelligence to take the call. So I think the multi-asset funds end up doing really well during those bear markets for equities.
Yeah, one thing I want to talk about specifically for the multi-asset funds. What we have observed with these multi-asset funds is they end up saving the smaller drawdowns for you. For example, if the market falls 5-6%, these multi-asset funds end up performing relatively well. But in situations where markets end up falling, let's say 10, 15, 20%, these multi-asset funds still end up falling about half of that, or 60-70% of the fall. Now the investors might still think that I'm doing relatively well as compared to the market, but what we try and focus on is build. So the way we try and look at it in terms of an absolute return, compared to the market. For example, if the market is falling 15-20%, can I still be flat? Can I still be sub 5% in terms of drawdowns? This is what we saw in March of 2026, when all the indices, including Nifty, mid cap, micro caps, gold, everything was down 10, 11, 12%. All of our strategies were flat. That gives the investors the confidence that I'm invested firstly in the right thing, and secondly the confidence that now I can buy assets at a cheaper rate. From the portfolio standpoint, 100 must have gone down to 90, and now when I'm buying, when I'm rebalancing, everything gets bought at 90. So I end up making more on the upside as well. So the way we are different from a multi-asset fund is they try and save for the smaller drawdowns, but let's say a COVID type situation or a 2008 type of situation, they'll still end up falling significantly more as compared to what we offer, and that is where I think the gap is.
You're talking about the outperformance we saw, which was a massive one in the month of March. If you talk about particularly the month of March, we could see that in fact gold also saw 12% kind of a fall, and we could see a correlation when the both assets, equity and gold, have fallen, and we've been able to safeguard our portfolios from that. How does one go about doing that and protect when both the uncorrelated assets end up behaving in the same manner?
So, this question we get a lot from investors, that say you have gold or commodities, and there are times where correlation does go to 1, where equities are also down, other commodities are also down. Ideally, if as a layman, if markets are at peak valuations, or if you think that you're going to enter a bear phase, the one thing that an investor could do is move to cash, or move to debt, or move to bonds, and move funds from one place to another. Now what we end up doing is try to have a negatively correlated asset rather than just moving to cash or bonds, and that's how we end up protecting the portfolio.
So Rishabh, you mentioned about debt and moving to cash. What role does a debt kind of a fixed income asset provide in a multi-asset portfolio, especially if you look at the news flow like RBS paused rate cuts and there's inflation rising? How does debt play into a portfolio like that?
So see, debt provides the stability in the portfolio, because like you mentioned in the previous question, that what happens when you're moving to say a gold and equity portfolio, but correlation is 1, like in March where everything has fallen. So gold is also down 8%, equity is down 11%. their debt ends up outperforming all these assets. So you have to understand that in which environment you need to have debt. Debt alone is not a bad product, but it's important to understand the environment that you are in, and does it make sense to hold debt in that environment. If assets are extremely overvalued and you're in bubble territory, it might just make sense to hold on to debt funds. But say we are in this today's environment of extreme money printing and inflation is just ticking up, then maybe holding on to debt can be a bad idea. So as an investor, you need to understand the environment, and then allocation to debt could make sense.
Alright, so like treat it like a tactical call rather than an investment that you're making in debt.
If you look at Warren Buffett today, for him, the way he looks at the markets, he looks at it from a very clear lens. If equities are not attractive, or if there is no individual, in his bottom-up approach of investing, if there is no individual stock available at an attractive valuation, I rather sit on a 7% yielding or a 5%, 4% yielding bond rather than moving my money to equities.
So let us get to a specific situation. Let's talk about the current situation. So the Iran war that people are talking about, it's been more than 2 months. The war is not, the Strait of Hormuz and the entire conflict is not resolved. So given this kind of geopolitical risks that are there in the markets and where the valuations are, how should someone structure their portfolio in a multi-asset point of view? What would you comment on the current situation?
The idea, and get to the thought process first. The thought process of a multi-asset portfolio is to outperform the market regardless of the situation, or to outperform sort of in a volatile environment. We've realized this, that multi-asset portfolios underperform during euphoric phases where one asset, like say equities, will go berserk and it's up 30-40% that year. In those years, you are conservative as a multi-asset investor. So the objective of a multi-asset investor is to have a smooth ride. So you're going to go from point A to point B, but that the journey from point A to point B is going to be smooth sailing. It's not going to have large ups and downs. How do you position yourself in specifically cases like war? Ideally, you have equities. Within equities, you can have low vol momentum. There are multiple factors which are uncorrelated. Then you have gold as a part of your portfolio. Then there are other commodities also, but you need to understand how the working of those commodities are, and you can create a combined portfolio. Bonds can also become a part of your portfolio. Now, if you just compare this on a CAGR basis to a pure equity portfolio, there is a good chance that you might be at par or you might underperform. But you don't want to only look at CAGR, you want to look at risk metrics over here to know that, okay, fine, say if Nifty does a 12% and a Nifty plus gold portfolio also does say 11-12%. Now look at the drawdowns, look at the bad phases, look at the sharp ratios, and that's when you can really see the the light on the multi-asset portfolio.
Right. So I know you both have touched upon a lot of concepts here, but if we have to cut it down and get to this one question, how do I build a multi-asset portfolio? What is your approach? And what are the assets specifically and the asset allocation? How would you go about that entire process? So I would like to know the approach.
So if someone had to start, to answer your question, Pratik, if someone had to start building a multi-asset portfolio, start with something really simple. Take Nifty. Look at the long-term return. Say Nifty last 20 years has given 12% per annum. The worst period has been 2008 in terms of the largest drawdown, where Nifty saw 57-58% peak fall from the peak, and then 2020 it saw 39% fall from the peak. Now start adding one more asset to this. So let's look at a very uncorrelated asset, gold. If you add gold and you do a 50-50 portfolio, so you do 50% invested in Nifty and 50% invested in gold, you will observe that the long-term return is pretty much similar to what the Nifty has done, which is 12% per annum, or slightly more because gold has done fairly well in the last 2-3 years. So maybe it's 13% per annum. But now look at the drawdown numbers. In a year like 2008, your drawdown has gone from 58% to straight up 25%, and in a year like 2020, 39 has come down to maybe 15-20%. So you have cut your drawdowns by half. You've seen a sharp decline even in the smaller drawdowns, even in the volatility on the portfolio. Even if you look at the whole of last year, where Nifty did extremely badly in phases, gold has done extremely well in those phases. So something as simple as that. Now, how do you go on getting better? You keep trying to add assets to this. Maybe you don't look at Nifty alone. Look at within Nifty, you look at within the equity space, you look at other basket of factors which can actually reduce the overall volatility in the portfolio. And that's how we build the all-weather portfolio, by just trying and testing out different phases, and then you break down the market into regimes, figure out what portfolios did really well, what didn't do well. For example, we have momentum as a part of our portfolio because we know that when a bull market comes, it will do extremely well. So that's how you build a multi-asset portfolio.
So the final, mindset over here, what Rishabh is trying to say is that even if there's a situation where market is down 30, 40, 50%, can I still be down less than 10% within that situation? And that is the problem that we are trying to solve with most of our portfolios, and particularly Qode all weather, where we saw this come true even in last March when everything had fallen about 15%. We didn't fall more than 10%. Same thing happened in this March where everything had fallen 11-12%. We were down only about 1-2% during that same period. So when the risk of like falling, when the investors see that as less, they end up getting more confidence in the portfolio that they're holding.
Right. So the equity like returns from the strategy, but the volatility is like a bond kind of a characteristic.
Yeah.
So that's amazing. That's the whole objective. So the next question becomes, what are the key mistakes people make when they're trying to create a multi-asset portfolio? Maybe it's not switching to equity when it's lucrative. They end up sticking to a multi-asset portfolio in markets where it's much favorable to go in a risk on position, or some other things you've spotted that some people should understand about multi-asset portfolio and how they can utilize it well in their entire investment strategy.
So I think the key to making money in the markets is having good entry points and seeing markets with a lens of risk. Now most people don't know what to do when markets are at peak valuations or when things are not favorable, and your only go-to approach is be 100% invested in equities at all points of time. The one way that say Buffett or good investors have outperformed is by knowing when to be risk on and when to be risk off. If you have a multi-asset portfolio, what you could do is that you could remain always invested and then decide when to take action. Like you want to move out of the multi-asset portfolio when equities have done extremely badly. So markets are down 30%, everyone is pessimistic, and that will be the time to act. So when you will be least interested in the markets is actually the time to act and go more aggressive. And when everyone is talking about the markets, that's the time when you want to hold back. But how do you express this view is by holding a multi-asset portfolio and then deciding when do you want to get aggressive and when do you want to not get aggressive. That's how we end up utilizing a multi-asset portfolio internally.
You're right. I think one more thing that investors end up doing is, once they build a multi-asset portfolio, then a year later, 2 years later, they try and break down the portfolio in terms of the assets that they were holding, and then try and see what made them return and what did not. Let's say the same period, it's possible you're holding gold and gold didn't end up doing that well. At the end of 2 years, you decide that, hey, most of the returns came from these two assets, so let me double down on these two and trim positions that didn't work. But then they forget the idea of that was providing stability. Did that end up providing stability? Will it continue to provide stability? If they can answer that question rather than just looking at what has performed and let me double down on that, it'll help you achieve your goal better rather than trying to constantly switch between what has worked for a short period of time.
Right. So understanding the objective of a multi-asset portfolio would help you in your investment strategy.
Correct.
All right, perfect. Thank you so much and for those views. And let's get into our next segment, which is scroll check. So I'll be reading out some posts for y'all. So the first one is, my portfolio was supposedly diversified: 55% equity, 15% debt, 20% gold, 10% international equity. March 2026, equity down 10%, gold down 8%, international equity down 6%, bonds barely flat. Everything fell together. This is exactly why people say diversification is a lie sold by fund managers. My pure equity friends who held Nifty index are down the same amount. What exactly did my uncorrelated gold and international funds protect me from? March 2026.
Yeah, so makes sense, right? March 2026, across the board, everything was down.
Correct.
And the only thing that survived was a bond portfolio.
Right.
So I think, if you're looking at zero drawdowns, that is a myth. I think if you're looking at considering that I will always be in the green regardless of even if I hold a multi-asset portfolio, there are going to be phases like this where multi-asset portfolios will also be underwater. It's just that how much will they be underwater relative to the market will be a lot lower. So if equities are down 10%, your multi-asset portfolio will be down probably 6-7%. Now you need to keep in mind that if your objective is to make long-term wealth through equities, the multi-asset portfolio is just a parking mechanism. Some amount of drawdowns need to be acceptable. and that number could be 10%, 15%, or even 20%. What we are trying to avoid through multi-asset portfolios are large drawdowns. So even with all weather, we are not looking at that we'll never have a 4-5%. We are not trying to avoid those 4-5% kind of drawdowns. What we are trying to avoid is 2008 and 2020 kind of scenarios. That's our entire objective. So when looking at a multi-asset portfolio, keep your expectations also right.
Right. Even if it's an all-weather type strategy, there would be periods where it would trail the objective.
Absolutely, there are lots of trailing periods. So
Right.
don't think that you're going to have a 10 out of 10 win rate.
Right.
When you're going, that 10 out of 10 situations you're going to beat the market.
Makes sense. Next one is honest confession for the finance community. When the Iran war started and Nifty dropped 10% in March, I liquidated my entire equity and gold portfolio, about 2.8 crore total, moved everything to FDs at 7.1%. I told myself I was protecting capital. It is now late April. Nifty has recovered somewhat. ICICI Bank Q4 results beat expectations. Ceasefire is holding. FIs are cautiously returning. And I am sitting here with FDs knowing I need to re-enter. Every headline makes me more cautious. At what point does protecting capital become avoiding a decision?
Whoever this is, whatever you're doing here is sort of there's a trade activity over here. Basically, you're trading in and out of the markets. And one rule to remember when you're trading is that you need to have the decisions predefined, and you don't start deciding on the fly. So when you exited, you have to decide that okay, fine, at this market level I will re-enter, and you have to pull the plug. If you're going to watch the markets and then take a decision, it's going to be really late and you're going to miss out on trades like this. That's why at Qode we focus on quant investing, and the underlying premise of quant investing is to be systematic, have rules in place. If you're not going to have rules in place, you're going to miss out on multiple opportunities.
In fact, our rules helped us move into equities when this fall happened.
Absolutely.
And our investors benefited from that. So
Yeah.
you need to have a plan for sure. There's another post. Everyone lost money in March except ONGC investors. ONGC is up 35% since the war started. Coal India is up 22%. Hindustan Zinc is up 18%. These are the actual uncorrelated assets. Why are we talking about just gold ETFs and debt funds when you could have just held these PSU commodity stocks? Genuine question. Hindsight is 2020, but the data is clear. Only hedge for oil shock or oil crisis. I have shifted 40% of my portfolio to energy and commodity PSUs. Changed my mind.
Sure. So I can answer this question. So again, what's happening is this particular person who's posted this is only looking at a short-term period where there has been an oil crisis. Looking at companies that maybe have not been affected by that. Looking at again India that might not have been affected as some other country. But think of it 6-8 months down the line. What is possible is the Hormuz issue is solved. Now UAE is not a part of OPEC, and then now there are there's more supply. Maybe there's more supply from the US. Maybe we are accepting Russian oil, and then maybe the situation that you will be in 6 to 8 months down the line, that might not be true. What it is today. Now this is based on me subjectively trying to understand what should I do to my portfolio. Now let's try to look at from a quant lens. Over the last 4 to 5 years, what has happened is value as a factor has worked really well. But again, if you look at the last 20 years, value had not done well. The reason for value to have done well over the last 4 to 5 years is largely because of PSUs doing well. So for example, value has done close to 30% return over the past 5 years. PSUs at the same time have done close to 35% return over the same last 5 years. So PSUs working, maybe the idea to look at it as particular segment of the market working. Again, it's possible that it's not repeatable in the future. Rather than looking at just one event and then extrapolating it to what might work over the next 3 to 5 years, what you need to do is look at the last 20 years and then try and extrapolate it to the next 3 to 5 years. If let's say over the same period in the past, if a particular factor has worked, maybe it only works in that particular environment and does not hold true for different environments. So having an understanding of which environment, which factor might work. Again, for you to do this over a constant period, churning your portfolio every 3 to 6 months might not really work. Think of it as working 2 out of 3 times, not working more than that. Living with that much volatility within your portfolio and potential downside also within your portfolio, it's possible that that's possible, but not thinking about it as a short term switch. Think about it from a 15-20 year standpoint and then try and see what best I can do with my portfolio over the next few years.
Okay, guys. So we'll move on to the next segment, which is answering the internet. So we've got some questions for you, and they would love for you to answer them. So the first one is: I have 90% of my savings in equity mutual funds. The Iran war has given me serious anxiety. How do I rebuild my portfolio to have proper uncorrelated assets without triggering a large tax event?
So idea is now don't be reactive. Now after the war you've seen large drawdowns, so you want to move to multi-asset. It's possible that the time in April is to remain invested in equities. So you need to plan your finances very well. You need to take a step back and realize what your objective is, what your 3-year, 5-year goal is. If a 10% drawdown is going to shake you out of the market, then you should not be investing in the market at all. The idea of a multi-asset is that, in times like the war, you will outperform the market. But remember, during bull markets, when things are favorable, you will underperform. Now, don't then jump to a conclusion that, okay, a multi-asset portfolio is bad. So I think, before taking this reactive decision that today, because of the war, I want to move to multi-asset, try to understand what your 3 to 5 year objective is and then move to a multi-asset portfolio. And, we've spoken about this earlier, how to build a multi-asset portfolio.
Let's say someone wants to get into a multi-asset portfolio and then come back to equities when it's favorable. How should someone think about the taxable event at that time, or should he think about the alpha he would generate by taking correct decisions and not think about the tax? If you just have to touch upon that.
Sure. So I'll tell you at Qode, what we have tried to do is automate every decision that we want to make. Try and optimize it in terms of returns, in terms of volatility, in terms of tax. So try to systematically, do this. We have indicators internally telling us which segments are looking attractive and where should you be taking more positions. But the systems don't tell us on a weekly or a monthly basis. These are slow-moving systems. Maybe you're getting a signal once in 6 months that you need to move your portfolio to, maybe have a slightly higher allocation on a particular segment, lower allocation somewhere else. So the idea is reevaluate your portfolio, on a 6-monthly basis, maybe act on it on a yearly basis. If you act on, rebalancing your portfolio on a yearly basis, you will see that you're anyway paying, long-term capital gains tax, and the tax impact does not end up being a large amount. So the idea is, as Rishabh mentioned, predefine those events where those switch will need to happen, base it on something underlying rather than reacting on news that you might be consuming, which might be coming out at that point in time.
And our investment decisions, we've been able to test them net of tax. Do they make sense?
Correct.
Absolutely.
Next one is, I keep hearing about REITs and InvITs as alternative assets. Are they actually uncorrelated to equity in crisis like Iran war? That's the question.
See, if you're looking at, like say correlation or uncorrelation in terms of volatility on the portfolio, yes. If you look at years like 2008, REIT means that you're actually REIT and InvITs. So InvITs are basically infrastructure related and REITs are real estate related. In a year like 2008, everything was down. So even if you would have been exposed to a REIT, when the global economy is tanking, all sorts of assets end up doing badly. But from a volatility perspective, over shorter term, it does, end up outperforming a pure equity portfolio. So it could be considered as a part of a portfolio, but understand what is there in the underlying portfolio. What kind of REITs you are exposed to. Are they commercial? Are they residential? What is the taxation on that REIT? And look at like maybe, in India, it's fairly new, like 4-5 years of data available on REITs, but outside of India, there are lots of ways to have exposure to REITs, and look at that and how it is adding to the portfolio.
So the next question is, my advisor keeps telling me that the best hedge against the Iran war is to buy more Indian quality stocks with no oil exposure. He says that is better than gold or bonds. Is he right?
So again, don't look at this one singular event and then decide a multi-asset portfolio. One thing that we missed out in all of our conversation is that if you look at, factor-based investment portfolios that have done well in 2025. So 2025 was a bad year for equities, but one factor that did extremely well was the value portfolio. So value as a factor did extremely well. If you want to evaluate a multi-asset portfolio, don't take one situation and then say, oh, in this situation a certain factor has done well, or a certain type of business has done well, because that situation is not going to repeat, or it's going to repeat in a different form. Like today we are seeing drawdowns because of the Iran war. Tomorrow it could be another pandemic, and same commodities could do extremely badly. So take into consideration different events, look at longer durations, and then see how you can create a multi-asset portfolio.
Selectively looking at these two events and making an investment strategy out of it is not a very good way to invest.
Absolutely.
Correct.
So thank you guys. That was a great conversation. The Iran war has been brutal, but clarifying experience for Indian investors. For those fully in equities, March 2026 brought real pain. Those with genuinely uncorrelated multi-asset portfolios, it was more manageable. The difference is that core value of asset allocation, it doesn't predict events, eliminate volatility, but it helps you stay invested through shocks instead of exiting at the worst time. In today's conversation, gave you a clearer lens why your asset allocation is most important in your investment decisions. Please consider subscribing. And for deeper market insights delivered straight to your inbox, join the Qode newsletter.